Good afternoon and a very warm welcome to everybody who's joining us now for the third session of the day. In this session, we're going to be looking at property development and bridging finance. We have two excellent speakers focused on this area with many years of experience behind them, and they'll be sharing their insights of the property sector. Firstly, we have Kiran Mehta. He's the Managing Director of Igloo Finance, an organization which focuses on bridging finance, commercial loans, and mortgage solutions. Kiran Mehta is also a business coach and mentor to family businesses. And previously, he was the regional director at Lloyd's. I think he was responsible for something like 140 different branches and overseeing 1,500 staff and the banking needs of over 1 million customers. He has got a huge amount of experience in finance and will be giving his insights into bridging finance. We also have Suneet Jain, who is a property developer, is the managing director of Mera Real Estate, and he's going to be outlining what is involved in property development right from initial planning right through to execution. So without further ado, let's bring on our first speaker, Kiran Mehta. So Kiran, over to you.
Does that work?
Yep, that's right. Brilliant.
Okay, thank you for your patience. Ashish, thank you for the introduction. If I can just add one more thing to that. I'm Managing Director of Igloo, and obviously you can see the disclaimer. I'm also FCA registered directly with the FCA and authorized by them, which is one of my requirements to mention, so I'll just mention that. One other thing is, which again I wish to mention, is the bridging company. We are credit brokers, and my son's company are bridge lenders, SDK Limited, and we are their sole packagers. So it's family associated. So whilst brokering is one side, lending is within the family, and I'm obliged to just be transparent and open with you. So I'm sharing that. Okay. So what will I cover briefly? I'm not sure about the people listening, whether the depth of it. So I'll try and keep it basic, simple, and we'll pick up the questions later on or offline as appropriate. So first of all, I'll cover a very brief overview on the financial market, and a lot of it has been covered before. So I'll do more to do with the financing of it. What is bridging? Simple stuff. Why we do bridging? Some examples of it, the risk associated with bridging, and then how to obtain it. So let's just take financial markets. So obviously COVID has had a huge impact. The high street banks had to completely change what they did. Every business development manager or lending manager I speak to, they have been extremely busy dealing with the government support lending, which is the CBILS, bounce back loans, etc. And the bank's exposure to lending is significantly higher than they'd expected. So the banks have to reposition themselves. So it's had a huge impact on the high street banks, where traditionally most of the borrowers would go to. And now, as it stands at the moment, our experience, generally speaking, is that the banks will entertain existing relationships, where and particularly mid-market or larger ones. The smaller lending, SMEs, is tougher. So generally over 2 million lending, unless there is a strong relationship, is what is being looked at. Whilst there may be others, it is taking a significantly longer time to move that forward. This is the high street banks. So even some industry sectors like health and property, which has been more attractive, are difficult to borrow from the tier 1 banks, which is the high street banks. As a result, there is pressure on the tier 2 banks, which don't have high street presence, but they will provide same as the high street banks. And the business has grown in that sector, and there is a little bit more pressure there, and therefore it takes longer. Now, let me explain other aspect of it, which is a significant change. Traditionally, in UK, 80% of the borrowing was directly go to the bank. So if you want a mortgage, buy-to-let mortgage, commercial loan, buying a shop, restaurant, buying a property, 80% would end up, generally speaking, straight to the bank. And 20% via brokers or intermediaries or families or venture capital, etc. The American market was 20/80. Australian is around 50/50. But over the last 12 months, it's changed significantly. Many of the bank managers have been de-skilled, and commercial lending managers have been very busy, as mentioned before. So 30% roughly would go direct to the bank, and 70% would go through brokers, because it's becoming more and more specialist. So if you want health product, which bank you go to, if it's a property, whether it's development finance, whether it's a straightforward property, any commercial lending, 70%, nearly 70% is going through brokers. So that's where it is. So unless you have a very strong relationship with the high street bank, the best option at the moment is to source a broker. So for us as a broker, this is a growth industry. So before I move to bridging finance, commercial lending is again an option is to get to a high street bank, alternatively to go to tier 2 banks. And again, commercial lending is very, 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 very broad. But there is specialists, different banks prefer different aspects of it. So again, it's case by case. But our specialty, to be honest with you, I want to talk about more today is the bridging finance. The bridging finance, so what is it? It's a gap between the current situations. If somebody is not receiving funding from the bank, then they will be bridged until they can get funding from the bank, from the high street banks or tier 2 banks, and they get a term loan. So this is just to bridge it for approximately 12 months, and it can be 6 months, it can be 18 months, it can be 24 months. We're just bridging the gap. Traditionally, bridging finance was started because you're moving your residential home, and you've sold yours, but you're buying 2-3 weeks before. So it's called close bridge. So you just bridge it for 2-3 weeks, 2-3 months, or 2-3 weeks, whatever the gap is. What's happening is this industry's taken off since 2009, last financial crisis, and bridging finance is used for normal commercial business now. It's short term, obviously. It's interim financing, pending term loan or high street term loan, or even selling the property if somebody's flipping it. As I mentioned, generally 12 months, it can be higher. So why bridge? So you cannot obtain funding from high street banks or tier 2 banks, then one needs to bridge earlier. There are many examples. Auction purchase. This has become a growth industry again. Auction purchase is speed, 10% deposit is paid, and within 28 days, completion needs to happen. That is virtually impossible in the current climate to get lending facility. So normally it's either cash purchase or bridging finance. That's what happens, unless there is traditionally credit lines from the banks for certain customers. So auction purchase is very, very commonly used. Conversions. So this is happening more and more. Pubs, churches, now high street, where there is conversion. So there is planning requirement. The banks require the serviceability. So where is the rent coming from? How much is the rent for them to lend? That's the traditional lending. Now, bridging finance will be done until the planning's done, conversion's done, rent is received, and then it's onto the term loans with the high street or tier 2 banks. So that's another reason. Very, 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 very much again a growth area, conversion. Many commercial properties converting to residential. We heard earlier on about high street. is another opportunity where some parts of high streets will be converted to some residential or mixed use. So again, that requires planning permission. Lack of income. This was talked about a little bit earlier on. There is opportunities where there is property requiring light refurbishments, heavy refurbishments. So someone buys a property, they need 3-6 months to renovate the property, ensure that they can then tenant it. During that time, there is no income. Therefore, again, bridge finance is a solution for that. Credit rating. The different lenders have different views about this, all the way from clean credit through to even if there is an IVA or number of county court judgments, then they're lending against the asset. So there is an issue with the credit rating, or new to the country, they've only been here for a year or so, and they've not built the credit. Although there is nothing negative, there isn't any credit. Or alternatively, there's an overseas investor who is difficult to get credit rating here. Again, bridge lending is a potential solution. Equity release for further purchase, quite commonly used with landlords with property portfolio. If they got equity in another property, they can release cash or give it as an additional security, so that they can buy a property at 80%, 90% loan to value with low deposits. And as you will appreciate, any property industry is highly geared towards financial requirements to grow. Higher loan to value, just mentioned that before. If one wants to know, traditionally 70-75% loan to value for residentials, or commercial maybe 60-65% loan to values is standard. However, if one has got additional security with more equity in it, then one may go to 80-90% loan to value, even 100% loan to value. So this is where it's helpful. So if we then look at the risk with bridging finance, it can be quite a nerve-wracking unless somebody's done one. It is quite expensive compared to traditional finance. So priority should always be to go to high street bank or tier 1 lender, go for a term loan straight away. However, where it is not possible, so the first thing, if anyone comes to myself, for example, is to see why is this not a traditional term loan or a high street bank. So bridging is a last resort. However, it works where it's below market value, or there's an uplift in profit. Auction properties can be up to 25-30% below the market value. Or if it's a refurbishment or a conversion, or converting a bigger house into HMO, house of multiple occupancy, there is an uplift available. Could be 20-25-30% uplift. Then the bridging cost can be digested within that. So it is expensive, and it's only appropriate where there is either a below market purchase or an uplift. Lack of clear exit is also an issue. If one buys one, the timeline needs to be right. If one thinks that it's within 12 months I will exit and they don't, then there are penalties, there are extension costs. Ensuring that the timelines are right to either sell or refinance, very, very important. Otherwise it can be quite expensive. So these are the factors to be very, very mindful of. Change terms during the lending process. It's unfortunate in the industry. Many lenders will change the terms along the way. So may say we'll do 70% loan to value, valuation comes in and the loan to value is dropped, or the interest rate has been slightly changed. So the initial offer is made, however, it changes through the process, which is a little naughty, but that happens in the industry. So whoever is going for bridge finance needs to be mindful that will this organization do this or will they not do this? And if there is a likelihood of happening, then be mindful of that. Unable to service or exit, there is a risk. In the banking industry, it takes a lot longer. There is a lot more consideration, but in the bridge finance world, if one is unable to service the loan or exit it, then this will lead to repossession or receivers being appointed quickly. So there is definitely risk associated with it. So need to have ensure that there is sound thinking behind that. As said, sound advice. Moving on. So how do you obtain a bridge finance? If one cannot obtain the traditional high street bank term loan or tier 1, tier 2 lending term loan, or obtain from them, then a bridge finance is appropriate. Ideally via broker to identify good lender options. There are clients who will go direct to some lenders, but again, that's fine. Trade with caution. It's important to try and go through a broker who will be able to place it with the appropriate lender if they are aware of the market. There is generally an application process which requires the standard details of the individuals or limited company. The bridge finance can be in personal name, can be in partnership, can be in limited company, can be LLP, can even be in somebody's pension trust. So even a pension trust can have a bridge finance. So legal entity is not an issue, but in terms of application process, obviously, then the details are of everyone involved. Property details, personal details, ability to service the loan, plans for the exit, KYC, know your customer stuff normally. If it is being serviced, then either the rental income or previous accounts, bank statements, just general standard finance requirements. The big difference with bridge finance is it is very, very quick. If you talk to decision makers, if one talks to goes through the application process swiftly, the offer can be out within 24 hours. Now that is tough in the tier 1 or tier 2 markets, but with bridge finance, it is very, very quick. So once the application is done, generally speaking, offer in principle is issued, all the terms are in place, and that's until then there should really be no cost. Then follows on obviously the valuation. That's when the costs will start. Following the valuation, the legals will start. So then there is the valuation cost, the legals cost. Generally speaking, in bridging finance, the borrower pays their solicitor for the borrowing, but the borrower will also pay the lender's solicitor's fees. So there are 2 legal costs attached to it. So I haven't done the terms, but generally speaking, you're talking about 70% loan to value, 70 to maybe 75 on residential buy-to-lets, and 60-65% on commercial. In terms of the fee, there are usually arrangement fees of approximately around 2%. Again, these will vary a little up and down. Interest rates are around 1% a month. If the loans are in excess of £1 million, then there is a greater negotiation on it because the sums are bigger. There's valuation cost, depending on where the property is and what type of property it is. And then, as I explained, legal cost. Probably, if it's up to £500,000, maybe £1,000 for both sides plus VAT. If it's more than that, again, need a quote. So that's generally the very much a general picture. And any questions I'll take afterwards, I guess after Suneet's presentation. And anything that's wider or more complex can follow that up offline. Thank you, Ashish. Back to you.
Thank you, Kiran. Really good insights in terms of if somebody's new to bridging finance to understand what's involved and what the process includes. So brilliant. Thank you for that. Suneet, if I can bring you on screen now. Um, yeah.
I'm trying to share my screen.
Yeah, we can see it, yes.
Good afternoon, everyone. I am Suneet Jain, Director and CEO of Mera Real Estate Limited. Uh, Thanks, Kiran Bhai, for a very informative session on bridging finance. Uh, Many thanks for taking out your time on Sunday, everyone, for this presentation. And I would extend my gratitude to Ashley Wood, Ashish for providing this platform, and Bhavni for working behind the scene to make this happen. In my presentation, I would be speaking about the development process and will touch on some key issues where most of the builders or developers go wrong during the development cycle. The development process comprises of an array of stages, with each stage having its own element of complexities. Going through the whole process with these added complexities in approximately 10 minutes would be challenging. But I hope to provide a high level understanding of the process. Please feel free to ask more in-depth questions during the question and answer session. The development process. Here we have a before and after image of a recently completed project in March 2020. This was Quinton Court in Purley and was a development of 9 flats. Throughout this presentation, I'll be referring to this live example. So now we start with the development process. So this is the flow chart of how a development process would look like. I have done it in 7 stages. Different people can have a different flow chart to it. So we start with the land research and appraisal. If we are happy with that, then we move to purchases. After the purchase, we move to the conceptualization stage of the project. Then we move to secure planning, permission, and building approval. Then starts our pre-construction and construction phase. Once the construction is done, our product is ready for sales. Once sales is done, we want to do an analysis on what our budgeted costs were, what our budgeted profits were, and whether we have hit those numbers. If any variations, then obviously there are lessons to be learned, which then act as an input again for the next land research and appraisal. In a nutshell, the above flowchart shows the development process and the key stages involved. I will be touching upon all these headings briefly in the next couple of slides. Each stage is as important as the other. And as a developer, my advice will be to have an overview of all these stages well in advance so that the issue of delays in a project can be avoided. Delays in a project have costly repercussions, and this is where most of the developers tend to falter. I would also strongly advise to involve appropriate property professionals to avoid costly surprises. Okay, let's move to our first stage, land research. I've done land research and financial appraisal on 2 different slides, though that is my first stage together. So this is the first and the pivotal stage of any development. Key things to consider are shown on this slide. Very simply, if the land or property you're buying for development is not researched to the T, you will incur overrun costs, the lifespan of the project will be elongated, and ultimately the ROI will be grossly impacted. Also, as a developer, you don't only build houses, but build your reputation and credibility with the agents, consultants, contractors, subcontractors, and all stakeholders. So thorough research at the inception stage of any development is vital. Once you are happy with your initial research, you move on doing a financial appraisal. So in land research, you need to pay clear attention on title of property, whether the title is clear, whether it has any things which are important to look for from a property developer's point of view is, are there any covenants on the title which will stop you from developing it? What is the planning history of the property? Has anybody been successful or unsuccessful in getting planning on the property you are buying? Researching the neighboring properties will also give you an insight into whether a precedent is already there for a similar development. Also important is site-specific constraints. For example, you might have a tree which might have a tree preservation order, due to which the development might not be feasible. So I strongly recommend anyone to go have a look at the site, understand the site constraints, and then move on. Planning policy of the local council is very important to know. And then you can do a massing exercise on it, that on a particular piece of land, how many flats can you get? For example, on this one, we did a massing exercise and we realized that we should be able to get 9 flats on it. There are key professionals which you might need during this process. You might need an architect, you will need a solicitor, you will need town planner to do the massing exercise for you. The planning consultant looks at the planning policy and works along with the architect and the town planner in order to make your dream come true. So the team of professionals around you is very important. Now we move to, once we know that yes, there is a possibility of getting planning on it, our next stage is to do a financial appraisal on it. Is the project profitable? On this slide, you can see a very basic appraisal table which gives an idea of the viability of a project. I want to re-emphasize that this appraisal template is overly simplified. However, it does cover the key aspects which should be taken into account. Firstly, you must calculate the GDV, which is the gross development value. For this, you should get the comparables from the local state agents. You can also do your own research on Rightmove and Zoopla, and there are many other websites available. Once you have got the GDV, then there will be a selling fee which you would be paying an estate agent in order to sell your development. In Quinton's quote, we have forecasted it to be 41,350. So that gives our net GDV of 3.4 million. GDV less selling fee will give you the net GDV. This gives you the revenue. After this, you calculate all the cost and derive your total development cost. Every company has a targeted profit margin on GDV. Once you have plotted these numbers, you would be able to work out the residual land value you require to offer in order to purchase the site. So basically what we do is we derive the net GDV, we plot in our construction cost, our professional fee, our utilities, SIL Section 106 agreement, our finance costs. That gives us the total cost. We also plot in our targeted profit. For this one was return on investment. We were looking at around 50% on our investment after leveraging. So we plotted that one on, and that gave us the purchase price. This is what we offered to the state agent. We offered 1.25 million plus ancillary cost took us to 1.373 million. Friends, number crunching is crucial. It's important to be realistic when appraising a project. I tend to be more prudent in forecasting the costs and the GDV associated with the project. If the project is expected to be profitable, then the next stage is the actual purchase of the site. So this is our return on equity, which I was talking about. So we wanted to hit a return on equity of 52.61% by putting in 1.5 million as equity. And this is the loan amount we took from a high street bank, NatWest. So next come purchases. At this stage, the consultant and the professionals play their part. Having a good team of professionals, as I said before, is imperative. You also must have a clear idea of the source of funding for your project at this stage. I must emphasize that this must be firmly secured rather than on an ad hoc basis. Next is the concept stage. Here we work on alternative schemes. The idea is to figure out the optimal scheme which would give you the highest return on investment. This is done along with architects, town planners, and planning consultants. Once the conceptualized designs are ready, we want to secure planning on the proposed scheme. Once that is done, we are ready for preparing building regulations drawings. These drawings gives us the specification of the build. The next stage is pre-construction and construction stage. The pre-construction phase is very crucial. Here it's all about coordination and ensuring that all working parties involved in the development are on the same page. We set out our timelines and key milestones during this stage. Here is an example of our flow plans and the project timeline. This slide shows a snippet of one of our project timelines, showing the task names and key dates for completion. Sharing this with all parties involved in advance would result in better coordination. Everyone would know what is expected of them and when. We are now ready for the actual construction. Construction is a long cycle in itself. Today, I won't be able to cover the construction cycle in this presentation. After the construction stage, the final product would now be ready on the market. Marketing is crucial to ensure that we attract potential suitable buyer. Although this stage is the last on my flowchart, in reality, it is something that we start working on during our construction stage. We start preparing marketing and CGIs and virtual tour right when we start construction. Launching the development of plan helps to reduce the timelines of the project. At Quinton Court, we reserved all 9 flats before construction was completed. This instills confidence in all stakeholders involved in the process. We also did a show home or a show flat at Quinton Court. Having show flats are a useful marketing tool as they help prospective buyers visualize what their future home can look like. At Quinton Court, we reserved all the flats before completion of the construction phase, and the sales conveyancing process had started well in advance, due to which we could complete all the transactions successfully within 15 days of the completion of the construction phase. I'm very fortunate to have a great team of professionals and in-house team around me, and I give them all the credit for our success. Thank you for all your time and attention. I appreciate that the development process is complex and I've only touched the surface of it, but I hope it provides a good starting point for those of you who are interested. Let's have a look at the time-lapse video of Quinton Court being constructed now. After the video, I'll be open for any questions you all may have. Thank you, and over to Ashish.
Thank you so much for that presentation. Really great insights into the whole process, and really nice at the end just actually to see the whole process from talking about spreadsheets and number crunching to actually see it all happen in a snapshot. So thank you so much for that. That was really really interesting. Right, so hopefully you guys have all found it informative, and I'm sure there must be some questions. So we will open it up to some Q&A now. So if you want to ask any questions, please do so using the Q&A button or any comments in the chat box, which you should be able to see on screen. And I have some questions from people who've already registered. So I'm going to take some of those first, and then I think I see a couple of others coming through online as well. So we'll try and again go through as many as we can. So one question we had was, how do you actually go about sourcing sites and potential property projects which are below market value so that they are likely to yield a good return? So in terms of sourcing, or any tips and considerations that you can provide?
The thing is that it takes time, in the sense that when you start a property development journey, you got to establish yourself in the market so that state agents and everyone can take you seriously. It's important that networking is very important. Performing on any transaction is very important, and yeah, once you start doing effective networking, once you know that you can perform, I'm sure sites will start coming to you. There are many websites out there where you can register. You need to register with local state agents. You need to tell them, you need to show that you are a serious buyer, and you have the funds in position, because then only they take you seriously, and then they will start sending you sites through.
Excellent, thank you. And I think that links into a question that we've got online. Is it, what is the biggest factor in growing your development company? And I assume it just lends on from there, the networking and making sure you have the connection of all the different aspects of
So
the
yeah,
development journey.
networking is, as you have seen, the development process. It's just not about buying the site. The biggest challenge with the development process is the construction itself. At the end of the day, anybody with money might be able to buy a site. Completing it successfully within the budget, within the forecasted timeline, is the key. So you need to master many processes within the processes itself. And obviously, it starts with a small one. For me, if you talk about myself, I started 20 years back as a buy to let investor. So once you get into the field, and once you know how to apply, what you learn in every project, you learn something new. If you can take those learnings and keep moving ahead, and I'm sure with time, you will have the knowledge, you will have the experience, and you will have the network to be successful.
Can I just add one thing to that, Suneet? Yeah, just many will go on their property journey with buy to let, then doing a bit more light refurbishments, then some conversions, understanding all the council requirements, extensions, planning, building regs, and move forward. And then development is probably at the peak of it, where there's so many complex factors come in. So those who've done really well, many start with buy-to-lets and so on. And I've seen last 11 years journey where somebody's buying the first buy-to-let and now having a portfolio, if you like, of properties. And part of it could be some development work, maybe slightly smaller, but still development work. So very true. It's getting onto the first project of a significant size as a development is challenging.
Thank you. Yes, I mean, I guess it's like if you're looking to start your own development company, to start off, it'll take a good number of years to get yourself really established, and there could be synergies in sort of linking up with existing developers to try and get sort of things rolling and started. So no, thank you to who's asked the biggest factor in growing a development company. We've got another question. I think it's a bit more of a general question. Somebody's asking about if they're first-time buyers in the market, is the outlook better to buy at the moment or rent via a flat? I guess maybe Suneet, you can shed some light in terms of the kind of developments you're seeing. Are you seeing lots of house building projects you're taking on, or more sort of flats that you're developing?
So we develop both housing scheme and flatted schemes. Basically, our every company has got their own market segment where they want to be. We as a company, we try to be within the help to buy sector. So our houses are typically below 600,000, because we think as a company that that is the market to be in. That is the market which is supported by the government. And for the foreseeable future, we think that the government is going to be supportive of this segment. So this is answering to what Ashish asked me. So this is the segment where we are answering to the question whether they should buy now or they should keep renting. Uh, okay, in the short run, the market might, it's anyone's guess. If anyone says that they know how the market is going to move, uh, it would be interesting to listen to them. In the short run, we don't know how the market is going to move, but as a housing industry, we our fundamentals are very good in the sense that there is a huge gap between demand and supply. So if your view is long term, you are not going to lose money. And rather than paying someone else's mortgage, why don't you buy a house and start paying your own mortgage? So I always recommend that for your own house, the market is not important. The important thing is that this is a house. It's rather than paying rent, please pay your own mortgage.
Also, just to add to that, Ashish, the current interest rates are so low that the actual monthly repayment might be less than the actual rent, like for like. I've seen it many times where somebody's paying 800, 700, 800 pound rent, and they actually have got a deposit and they can get a mortgage, then the actual monthly repayments are either similar or less. Therefore, there is as Suneet said, there is a longer term growth gain, property value gain.
Yeah, no, I agree. I think as we sort of discussed in the very first session of the day today, in terms of the long-term fundamentals, that they're there. It's a question of basically doing the due diligence and research behind it. So no, thank you. We've got another question. I think it's relating to planning permission. So it says it's difficult to judge the land and price at the time of buying, as you don't know what planning permission you're going to get. Any advice or thoughts in terms of planning permission?
Okay, so there are sites which we buy consented with planning, and there are sites we buy unconsented. Yes, there is a risk of buying unconsented site, but that is where having a good team around you is important. When we buy sites, before even we put an offer in for the site, if it's an unconsented site, we are going to we scan the site completely with our town planner, with our planning consultant, with our architects. So, see, every council has got a fixed planning policy. Understanding that policy for a layman might be difficult, but if you hire the right professionals to do it for you, it sounds very a tedious exercise, but once you keep doing it time and again, it becomes a second nature. So what we do is that we buy whenever we are offered an consented site, we will hire the right people, and then we work along with them. Yes, there is an element of risk still, but the risk is very calculated risk. So, for example, we were expecting there's a latest development. We are in planning in Purley, where we were forecasting we are going to get 9 flats, but we have ended up getting 8 flats because of some ridge height issues. So what we do is when we make an offer, we never make an offer on based on that we are going to get 9. You got to be a prudent and a clever when buying it. So we had done our sums based on 7, that if it works at 7, if you get 9, that's a bonus. Okay, you always have to be very prudent in your projections, because buying wisely and chasing a deal even if it doesn't stack up, is not the right thing to do. It's better to lose 5 of them and then get one rather than trying and chasing the deal. I strongly recommend to anybody evaluating it, if it doesn't fit your criteria, if it doesn't give you the profit margin, walk away. There's always a next one.
No, I totally agree, and sort of can sympathize with that. I think so often people want to work towards a target, and they do the spreadsheets and they sort of create a target for themselves. But one thing that you should always remember is make sure that you're very conservative in terms of your cost. Make sure that almost you're factoring in more cost than you realistically think, and also conservative in terms of your revenue stream. Just don't look at the bottom line and say I'm working towards this, and it's almost self-justifying your own projections. So no, thank you for the question, and I think the feedback as well. So brilliant. Again, a quick reminder: if there are any other questions, please do put them on the Q&A or chat icon, and we will try and cover them. Just a few questions in terms of on the borrowing side. Again, so we're looking at while looking and purchasing sites a long way away, it's shortfall of finance, getting loan and borrowing easily available. I think we've touched upon that already through the bridge financing. But maybe you might want to, Karen, you might want to expand upon it in terms of, I think you mentioned different types of structures can get bridge financing, whether it's a company or an individual. Are there any key criterias people should bear in mind when seeking bridge financing?
Yeah, in terms of Ashish, your question, whether it's individual or limited company, it doesn't matter from the lender as much because they'll cover through personal guarantees, etc. In terms of buying land, there is a different issue with it, because when does the income come? So if there is a bridge lender, what they would look at is that if somebody is lending on land, how is it going to be serviced? So the interest would be either rolled up or taken up from the loan value. So if it's a 12-month bridge and there is lending done on the land, they will take up the payment upfront. Then the exit issue comes in. So you've got the piece of land, you bought it, how will you exit the loan? Bridge finance. Bank funding, I'm not sure. In the current climate, I wouldn't try. I wouldn't spend time on it, but bridge finance would work. Now, the second thing is, what's the exit? So again, it can take 2 years, 3 years for the whole of it to happen. So once somebody's bought it, they've got planning permission and they've got the full architect's plan and all the processes in place, as Suneet explained. Then you do development finance. So then that goes into development finance. And again, there is a bridge finance available for development finance, where somebody will go in and do staged release of funds. So you may move from land finance to development finance. Quite an expensive exercise, but it is being done and it can be done. The important thing is to have a higher input into the project. As Suneet's example was, he's putting more than 50% of the project into that example. And similarly, the level of input required is significantly higher. And the timeline is higher as well. I hope that answers the specific question about the funding.
Yeah, no, thank you. And I think somebody asked along the way. So basically, if they're started on a project and then there is a shortfall in finance, is bridge financing still easily available? So this is kind of almost a mid-project.
Yeah, if somebody started a project and if it is a development, then one would go to development finance. If it is a conversion or a light refurbishments, that kind of project, then yes, bridge finance is available. What is happening at the moment is people who were 12 months bridges haven't been able to exit it as fast. So the other product that usually happens is bridge to bridge. So if they borrowed money for the initial purchase and done it as a bridge finance, and they're coming to the end of their term and they haven't finished the project, then there are two options. One is to extend it with the existing borrower, and that there could be penalties and higher interest rate, or go from bridge to bridge. So they go from one bridge to another bridge lender. So again, it depends on individual circumstances, their loan to value, the progress of it, the level of refurbishments. So something to discuss. but it is possible. And again, you have to consider, you have to concern that was the bridge done for enough? You know, like Suneet was saying, is it prudent? The timeline was in time, cost was in budget. Where did it go wrong? That kind of evaluation will happen.
Yes, no, thank you. And I think, yes, anytime there's a shortfall mid-project, many questions I'm sure will be asked just to make sure that there's eventually a successful outcome. So no, thank you for that. Brilliant. So thank you. I think we're coming up to just about an hour for today's session. So thank you so much for joining us today. Suneet and Kiran, if I can just go over to you for one sort of last couple of words before we close. Kiran, if you want to go first.
Yeah, I just want to thank you, Ashish and Bhavni, for creating this platform and giving us the opportunity. It's a pleasure working with Suneet as well. Interesting listening to Suneet. We talked before, but nice structured approach was great. Everyone listening, thank you for your time. Insofar as bridge finance is concerned, it is a definite tool for business in the property world, but need to trade with caution and ensure that it's thought through. Would be happy to help anyone. I've always got time. A lot of people are very busy, but fortunately, I've always got time. So any questions at all, just give me a call and I'll be very, very happy to talk. I don't waste of time in my life. Everyone is another relationship to build.
Thank you, everyone, for taking out the time today and listening to us. And if you have any further questions on development or anything where I can be of any help, I normally try to spend 1 hour a week trying to help any new property developer, or any questions you have. If we have the experience, if we can be of any help, you're most welcome. My details are available with Ashish, and I think he has shared with everyone. All I would want to say is property is a great asset class to be in. I simply love this asset class. There are so many things you can do with it. Like you can be into buy to let, you can be building a portfolio, you can get into development. We need to crawl first before we start running, as we say. Take baby steps, and I'm sure you'll be there. All the best. Thank you very much, guys.
Thank you. Thank you, Kiran, and thank you, Suneet, for your insights today. Thank you also, Barney, in the background. I know you've been working away the whole day today, helping with these sessions, so thank you for that. And finally, a big thank you to everybody who's joined us for this session, as well as the sessions, two sessions this morning we had on residential market, as well as the buy-to-let investment market. As we mentioned before, all the recordings are going to be available on the website. All the presentation slides are also going to be available on our websites, along with details of all the speakers. So if anybody does want to contact them and sort of connect up offline, you'll be able to do so. So finally, thank you so much for joining. Take care and enjoy the rest of your weekend. And a final thank you to our speakers once more, and for everybody for joining. Thank you and take care.
Cheers. Thanks, Ashish.
Bye-bye.
Thank you.